Good morning, ladies and gentlemen. Welcome to the show. Today is the 30th of December 2019. We're in the very tail end of 2019, and the financial system of the world is starting to come unglued. The reason why it's starting to come unglued is because they're juggling too many balls, basically. Cutting it down to the nitty-gritty, the Fed and the world's central banks now are juggling too many balls. They throw one ball up in the air and another one's falling, and they're trying to keep it all together. They're trying to hold it together. Let's start the charts right here and take a look at what's going on. Global stocks are clinging to record highs as the dollar, U.S. dollar, and Treasuries rate today are getting pounded. And the reason why the dollar's getting pounded is they're printing too many of them. And the treasuries right now, the banks are low on liquidity at the same time that they're printing too many dollars. Everything's starting to come unglued in the system. You know? Can they hold it together through all of 2020? Well, they're going to have to go back to quantitative easing. Quantitative tightening was a huge mistake. The biggest mistake they made was going back to 2008, trying to hold this system together through monetary policy. That was where they made their big mistake. And now it's getting to the point where they can't hold it together. Like I say, they're juggling too many balls. They should have let all those big banks collapse back in 2008. They should not have pumped all that money into the system and started quantitative easing to begin with. Once you start quantitative easing, you cannot get out of it. And right now, they're being pushed toward quantitative easing. When we see the Treasury yields rising, they're being pushed toward quantitative easing. This is the only thing that's going to stop these Treasury yields on the long end of the yield curve from slowly rising is to go back to quantitative easing, because the banks are starting to sell these Treasuries in order to come up with liquidity into the marketplace. Let's get in here and let's take a look at gold today. Well, let's just read a little bit of this before we go. It says, global stocks cling to record highs as the dollar and the treasuries get pounded. Global stocks and U.S. equity futures slipped modestly in thin overnight trading on the second to last day of what may be the best year for stocks in 22 years. So the stock market is pumped up right now, and it's holding today so far. Depends on how much these yields rise on the long end of the yield curve. So we're going to take a look at that coming right up. Let's get right in there and take a look at the gold prices today. We're up $3 on the day, $1,513.80 today, right now. The gold price is going up right at this moment, but it's in a very narrow trading range right now between 1516 and 1508, and it's pushing toward the high side of that trading range. Will it break out? Make a breakout of that trading range in today? I don't know. We're gonna have to wait and see. Let's take a look at silver today. Silver's at 1784. And it's following that very narrow trading range along with gold. You know, gold and silver move together. We're looking at the high side of that range for silver at 1795 and the low side at about 1770. And it's right in the middle of that range, and it's moving up right now. $17.84 right now. It's up 11 cents on the day so far. Take a look at cryptocurrency. Cryptocurrency is stuck in a rut. It's moving in the same trading range for days now. It's $195.6 billion market cap with 68.3% Bitcoin dominance. And cryptocurrency's been going sideways for a while now. It's getting ready to make a breakout. My tendency is to think that we've seen bottoms put in this bear market that's lasted quite a while in cryptocurrencies, My tendency is to think that the breakout's very possibly going to be to the upside, especially with all of the monetary stimulus going on right now. Like in the repo market and stuff, But I think they're going to increase this monetary stimulus. I think the pressure's coming on them right now to go back to quantitative easing again, real quantitative easing, not just Treasury bills on the short end of the yield curve, but to try to control the long end of the yield curve. Let's take a look now at the Dow Jones Industrial Average. It's down 94 points. It was holding its own just a few minutes ago, but we've had a sudden drop in the Dow of 94 points so far. 28,550 for the Dow right now. This drop does not surprise me because the Dow is watching what's going on in the bond market. And they're also watching what's going on in the U.S. dollar index right now. And investors are getting a little bit edgy, The euphoria that they've had over the last few weeks has been pumping this market up. Suddenly the investors are sitting there and they're saying, gee, maybe we're a little bit too euphoric. Look at what's happening in the bond market. Look at what's happening in the dollar index right now. It's probably upsetting them just a little bit. And it should. But this is going to be pushing the Fed toward quantitative easing. Let's take a look now at the crude oil. $62.11, and we're seeing crude oil up a little bit today. That's crude oil going up is a positive signal for the markets, but it can't help them if the U.S. Treasury yields on the long end of the curve. I'm going to tell you right now, the Fed is watching this yield curve today and watching these treasuries on the long end rising. Let's take a look specifically at the U.S. 10-year. Let's get in there and take a closer look at the 10-year. And, I'm going to show you what I see here. Just a sec. I got to get this down a little bit so we can see it here. If you're looking toward the end here, it started around August. If you're looking at this chart on the U.S. 10-year, started around August. You see it it made its bottoms, and you see the yield starting to climb ever since August. This has everything to do with the repo market. The reason why these yields on the U.S. 10-year are creeping up has everything to do with the repo market. And I'm going to tell you what, I'm surprised that they're not climbing more, considering what's going on in the repo market. They could be shooting up, but they're just very slowly climbing. You can bet that the Fed has got their eye right on the U.S. 10-year yields that are climbing, and they're up 4.8 basis points today. Let's look at the full end of the yield curve today, and we can see the long end is rising significantly, especially in the 30-year. 5.9 basis points in the 30-year and 4.6 on the 10-year. We're getting up close to 2% on the U.S. 10-year. U.S. 30 years at 2.37. U.S. 10 years at 1.92. This is what's going to push the Fed back into quantitative easing again. Real quantitative easing. They got to control these bond yields. If these bond yields start to really take off on the long end of the yield curve, they've got to bring that back down again. All means necessary to try to hold this system together, because if yields rise too high too quickly, it could explode this system, could take this system down, and they got to control that. And this is going to be forcing their hand to go back to quantitative easing, because that's the cure for this. But that's just a patch. It's like that's what they've been doing. They've got a dead economic system, and they've been patching it here, patching it there, and the patch is basically it's not holding together. It's falling apart. So that's what's happening right there, and these yields rising, and they're going to be pushed. They're going to feel pushed Let's take a look at the U.S. dollar index today. 96.77 on the U.S. dollar index. And it's falling. Banks, quite seriously, banks cannot survive in this environment. It's upside down. When you go down to zero interest rate policy and below to ZIRP and NIRP, negative interest rate policy, when you get down in that territory, well, if they had if the banks really had a strong, vibrant economy out there, people might lend at these lower rates because they've got room to borrow, and lend. And the banks might lend out. And this is the biggest tool of money creation, is the banks actually lending money out. That's a bigger tool of money creation than the Fed, but everybody's tapped out now, worldwide. They've borrowed pretty much as they can borrow. And so you don't have a vibrant economy. You got a economy that's running on credit and running on debt. And they're all tapped out. And the banks, if they go down below zero, they don't have much room to make any profit anymore either. And so, and a lot of people, who are they going to lend to? They're going to have to find unqualified lenders. And the whole system starts to come apart at the seams for the banking system. And so then the support has to come for that from the higher end of the system, which is the central banks to support these banks. And you got a system that's running basically upside down. We don't know how a system will run upside down on zero interest rate policy. It's never been tried before. And personally, I don't think it's going to work. But it's the only answer that they have left, is to try to go into these negative policies. They're already there in Europe. They already got negative interest rate policies in Europe. And the only reason it's actually holding together of any sort at all is the European banks still have positive interest rates in the United States and over here. We're still on the positive side. If we go negative too, there's nowhere for them to go. There's nowhere for the banks to escape to get into profitability margins again. And what we're going to look at is bank failures are going to start increasing, especially in places like Europe. This is just an upside down system. And I don't think it's going to function. Thank you guys for listening to this report. Happy New Year, guys. It's coming right in now. We're going to go into New Year's. We're on New Year's Eve coming right in. And we'll see you guys in the next show. Bye-bye.